So, Lee, I'm going to put up a chart here off my terminal that shows the pattern on the 2s-10 spread, the difference in the 2s and the 10s, and it really is pretty dramatic how far down it has gone. What we hear is we shouldn't be too concerned because the long end of the curve has been artificially suppressed both by pension plan investments and also because overseas central banks have had negative rates. The Bank of Japan just changed things. Might that change that phenomenon? Lee?
Oh, sorry.
Yeah.
Yes, the move by the BOJ has certainly put a little bit of a push under 10-year yields in the U.S. I mean, I would say, listen, let's look at this flattening of the yield curve compared with other ones, and there's a crucial difference. You go back to the mid-1980s. There's a crucial difference here, and that is if you look at the real Fed funds rate. Every time we flattened previously, before the 91 recession, the 01 recession, and then the financial crisis, real Fed funds rate was positive by about 300 basis points. That's indicative of a central bank with restrictive monetary policy, slowing the economy, and yeah, the yield curve reflected the fact that that points to recession. This time, the real Fed funds rate is still negative. We don't have restrictive monetary policy. This is all about technical factors. It's about low rates in the rest of the world, as you mentioned, and also, and connected to that, the size of the balance sheets now that central banks have, $15.5 trillion in the G3 compared with $3.5 trillion previously. So, that's a big buyer in the market. There's depressed long-term yields. If we see yields rise elsewhere in Japan and Germany, then we can see 10-year yields here rise. But you've got to think of these spreads. You look at the spread of Treasury over bonds, it's the widest for 35 years. It's very hard for Treasury yields to go higher at the long end when you've got that sort of spread.